no one wants to take the hard route. Every single crisis, and governments are going to react, they will always 100% of the time choose inflation and devaluations to a crisis that is systemic and the system collapsing. So we've created this addiction to the system that effectively forces them to step in every time. It's just incentivizing and rewarding the wrong behavior. And this beast is getting fatter and fatter.
Markets seem to have calmed down a bit after this week's volatility, but is the worst behind us? Diego Parrilla is here to break this down for us. He is a CIO of Quadriga Asset Managers, and he is also a visiting lecturer at the Imperial College London. We'll be talking about his views on the markets. Welcome to the show, Diego. Good to see you.
Thank you so much, David.
I'd like to start by talking about what happened this week. First of all, do you think the top is in for markets? Is this the beginning of a bear market for you?
Possibly. I think we have seen there's actually quite a few drivers that are influencing the markets. There's a number of structural issues that will put downward pressure from here, and there are others that are more populistic that are harder to basically factor in, or in terms of exact timing or magnitude. But certainly the pickup in volatility is a wake-up call to a lot of people of the risks of leverage and the excessive complacency of the markets. And there'll be a number of casualties that are going to show up in the next few weeks from all these moves. And I think this, we could see the short-term memory of the markets bringing volatility down and arguably perhaps supporting the market. But I think this volatility is something that will continue to show up. And the more you try to suppress it artificially, the more it's going to be, vicious on the other way. So, unfortunately, I don't have a crystal ball, so I can't tell you exactly whether, how these things are going to play out. But certainly, I think we've come quite a long way, and there's a number of factors that I think will keep things under pressure.
What is your assessment on growth then, economic growth? Do you think it's conducive to, I guess, higher stock market returns in the future, or do you think this is the start of a recession?
Recession is always an interesting concept, right? I mean, I think we've been raised and accustomed to this idea that negative growth is the enemy, and in some ways, this addiction to growth leads us to a number of decisions, monetary and fiscal, that sort of will do whatever it takes to try to avoid them, and even if they're often healthy and cyclical and natural. So I think in that sense, similar to the previous question, I think we need to differentiate between perhaps nominal and real dynamics. So I think it's very clear to me that on a nominal basis, growth can continue to look relatively robust. If in certain places in the world, we might see, inflation impacting in different ways, but I think ultimately in the long term, we should pay more attention to real numbers, and in some ways, nominal measurements don't show the real picture. They hide some of the abuse that you might have in the system and some of the structural imbalances. So it's obviously less obvious and not as easy to calculate, given the inflation component itself has multiple different ways in which it can be measured or represented. But I think similar to the previous point, I think the expectations probably are for them to remain positive, but at a slower pace. And I think the risk again seems, in my opinion, skewed to the downside.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on iTrust.capital/David in the link down below, or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Diego, I showed you this chart offline. It shows the Bloomberg U.S. Government Liquidity Index. And what it is that the higher the number, the less liquidity is in the system, is what basically what it represents. This index is a measure of prevailing liquidity conditions. Under stress liquidity conditions, dislocations from fair value result in an increased average yield error. What we saw is the highest number since the beginning of this chart, which is 2012. Do you think that lower liquidity in the financial system was partly to blame for the spike in the VIX that we saw on Monday?
Yes, absolutely. I think it's undeniable that liquidity has dramatically distorted the dynamics of the markets. There are multiple ways in which you can inject that liquidity and in the system, and eventually we go back to the previous points on inflation. I think all this money printing and ways in which you're flooding the system with money and inflation can effectively, for a while, make things look better than they actually are. And if you abuse the system and you print too much, and these things get excessive on both in terms of complacency and valuations, and eventually you feel that you need to tighten things out through quantitative tightening or other forms like hikes, this obviously removes that support. It's not coincidence that Japan, which has been perhaps one of the leading economies in the world and central banks that has in some ways been abusing monetary and fiscal as they started their tightening cycle, we're talking about truly marginal moves, 10 basis points, 15 basis points. But given the magnitude of the debt, given the magnitude of the artificially low rates, given the magnitude of the carry trade around it, these things can have ripple effects. And so, I think it's kind of worrying that relatively minor changes in liquidity can actually result in such dramatic changes in the market. And I think this dynamic with volatility and valuations and prices, I mean, it's part of the big picture framework of, this monetary fiscal abuse is not really solving problems. It's really just delaying, transferring, transforming, and enlarging them. So liquidity is very much behind many of these issues. And they're not so obvious to catch, but they're there behind the scenes. And every time, these things happen, mommy and daddy tend to resort to them.
Okay, so currently, as of Friday, August 9th, the CME FedWatch tool is pricing in a 48 or 49% chance of a 25 basis point cut in September and a 50% chance of a 50 basis point cut in September. Basically, a 100% chance of a Fed pivot, but 50% chance of 50 basis point cuts. And in November, we're getting another cut according to the CME FedWatch tool. In December, another cut, so on and so forth, January in 2025. Do you think the markets are pricing in too many rate cuts right now?
Well, exactly whether it's too many or not, I think obviously what matters here is the direction. We clearly have reached in some ways the local highs. If you think about Europe or other parts of the world that have already started the cutting cycle. So the US in some ways is keeping it longer for obvious reasons. You have a pretty strong equity market, very robust growth, and some signs of perhaps weakness on emerging. But it is to actually be cutting in here. There's also arguably two big explanations. One is we hiked because inflation was a problem and inflation is no longer a problem. Therefore, and we don't really need to be so restrictive. Or the other interpretation you could have is there's real trouble coming up, and they're going to have no choice but to cut. So one is a much more benign perspective of what might be ahead. The other one is perhaps less benign on the outlook. I think it's they're both true and have their merits. But again, I think the more aggressive path that is priced in now, in my opinion, is more linked to the adverse scenario of the Fed having to step in than necessarily the benign scenario that, you know what, we went too high and because these cuts effectively are, going back to your point on liquidity, are adding liquidity, are bringing support to markets, are bringing perhaps additional fuel to a party that is already quite on fire. So I think in that sense, the market is desperate for those cuts. Politically, there might be people who could argue that there are political implications there, whether it favors Trump or not. But so I think in that sense, in a nutshell, I think they look quite aggressive to me on the basis of the current setup. But it could well be that the market's also reflecting a more crude reality about growth and other things. But the bad news for the market is that those cuts, which are already priced in, again, are already being reflected in valuations of assets. So if you don't deliver them, then you get an unhappy market that could react. So it's a tough gig to manage for the central banks, and I think their back is really a little bit against the wall, and they will have to deliver some, but perhaps not as many as they would like, unless we have this emergency situation.
Yeah, it really depends on two things, inflation and employment. So let's finish our conversation talking about both of those things. Inflation first. You mentioned inflation earlier. Do you think that 3% is that was the last number that we saw as of June? Headline CPI 3%. Is that the lowest it can get for you, Diego?
Look, I think the problem with inflation is that we tend to refer to inflation as if it was this single number, absolute truth. In reality, your inflation is different from mine and from everyone that is listening. One of us, some of us have university fees, the other one has nappies. We have a very different inflation setup. So it's hard to just pinpoint things to one single number. Second is, as a result of that, the basket that we pick may not be representative of reality. And related to that, it can be easily manipulated to show and make believe the world that inflation is under control, when your pocket and my pocket and what we experience in a day-to-day is very different. So I'm really cynical and skeptical about this how much importance we give to these single numbers, but it's what the market takes, and you can't ignore that. So again, I think on that basis, the more adverse scenario that we discussed of lower growth, et cetera, could result in weaker, headline inflation numbers. But I think if you think about the other dynamic, which is the underlying issues that we're facing, I sincerely believe that inflation at the end of the day is a monetary phenomenon. Is more about it's not that your house goes up or down, it's the value of your dollar goes down. So I think in that sense, I believe that real inflation, which is at least twice the official inflation, it's going to remain high, regardless of what the prints do. And I think that eventually is a game that central banks are playing to try to keep us all frogs in this monetary broth.
Okay, so since you believe that it is a monetary phenomenon, I'll point out to you that U.S. M2 money supply growth is currently at positive almost 1%. Now, remember, it was at negative growth ever since 2022, just turned positive earlier this year as of April. Does that mean then that the disinflation that we saw throughout 2022 it's over, meaning that since money supply is now growing once again, albeit at a very small pace, we may see inflation tick up?
Yeah, that's right. I think if you think about central banks being opportunistic, about governments and central banks want to print as much as they possibly can, as long as that doesn't really send inflation and inflation expectations to levels where they lose control. And that's the name of the game. So if they can print a ton of money and headline inflation is below 2%, then they'll do it, right? I think it's only, and we saw that in 2022, once inflation expectations get out of control, that central banks lose control and they're forced to hike. So I think this is already telling you that despite the restrictive conditions, there's other ways in which that liquidity is feeding in, and they do it because they need it. I think again, this is more of a global game. So when central banks like China or others might be selling treasuries or doing other things, you actually need to factor in also, how you're going to react to that and how you play with the yields and who's going to fund who. And again, it goes back to my core view that in the long term, from a game theory perspective, this will end up with more printing, not less, and with more debt, not less. And this is inflationary, regardless of the cycles, and even the deflationary crisis actually require more printing, not less, which is why inflation is structural.
Fundamentally, why does there need to be more money printing, Diego?
Well, it's the easy way out. I mean, as a central bank or government, when you're facing problems, they always resort to the same. They effectively pretend, and a lot of people believe that you can actually solve problems by printing money and debt. But they're, as I said earlier, they're delaying, transforming, and enlarging. But every single crisis, whether it's a banking crisis or economic growth or anything, a war, whatever, every reaction is always the same. Energy subsidies were printing money. The bailout of the regional banks was printing money. Every time you guarantee a company, you nationalize. I mean, all these exercises always the same. So I think in some ways it goes back to your point earlier on recessions and other dynamics, which leads us also to political cycles that are just too short in the overall scheme of things. Within 4 years, you come in and you want to get reelected, and you're going to print and borrow your way into elections. But if you're facing problems, no one wants to take a hard route. And look at, again, any example, but even Japan this week, right? You try to tighten things, and before you know it, the Nikkei is down 20%, the yen's appreciated, and faced with this crude reality of the damage being done and how mommy and daddy, central banks and governments are going to react, they will always 100% of the time choose inflation and devaluations to a crisis that is systemic and the system collapsing. So we've created this addiction to the system that effectively forces them to step in every time. And it's not like we're learning the lesson. Every time we're being bailed out and you have this central bank put and mommy and daddy coming to the rescue, it's just incentivizing and rewarding the wrong behavior. And this beast is getting fatter and fatter.
I'd like to show you this chart. This is the velocity of money stock, which is defined as the quarterly nominal GDP divided by M2 money stock. Do you look at this chart or the money velocity overall as a gauge of inflation? Is that important to you? It's defined here by the St. Louis Fed as the velocity of money is a frequency at which one unit of currency is used to purchase domestically produced goods and services. What's your interpretation of this chart?
Yeah, of course. I think as a central bank, you want your money to do the job. You want it to run. You want it to convert into monetary activity. And so I think the velocity at which things are, that money is acting effectively is helping your case. The opposite would be I'm printing money and that money is being just left in the bank account and everyone's too scared to do something. So I think again, in the short term, you want obviously that thing to move. The critical point here when we talk about inflation is there are two dimensions. One is inflation itself, and the other one is inflation expectations. And inflation itself, 2 + 2 = 4. you print X amount of trillion dollars, you're diluting the purchase power. That's one side. But once you go into that velocity, that acceleration of money converting and becoming effective inflation expectations that accelerate, then you start to lose control, and that becomes a big issue. So these are important metrics to monitor, of course.
Finally, the dollar, the DXY index. If you take a look at the DXY index here, all throughout 2022, when we had inflation, actually the DXY appreciated versus other currencies. Usually when we think about inflation, we think about the dollar losing value. But vis-a-vis other currencies, it hasn't. Can you evaluate the strength of the dollar going forward?
Absolutely. I think it's fascinating because if you think about the traditional game in currency wars, was to devalue your way out of trouble. So effectively, if you were printing too much money, you wanted to dilute your currency, you wanted to be more competitive, and you were in some ways attracting, jobs and investments and factories and whatever at the cost of inflation and maybe not going away on holidays and other things, right? And that's kind of the way the world worked for a long time until suddenly inflation comes in, and then the game changes because what you want is pretty much the opposite. So a scenario where the dollar has a serious inflation problem, that you don't want that devaluation. You're happy with the appreciation, and I think what's interesting about these dynamics is how they impact the weaker links, the people that have been abusing the system the most. And so I think in this scenario, currencies are not absolute assets. They are generally looked at in relationship to something else. And if you think about the yen or the yuan or the euro or the peso or the dollar, I would argue that the dollar in that domino, it's definitely on the stronger side. And a scenario where the Fed is keeping rates very high, rate differentials wide, which prevent the other guys they force the other guys to follow them and tighten and create local crisis. I mean, you see what happened in Europe. Europe lagged on the hiking and is actually led on the cutting. So the dollar, what happens to the dollar rates matters a lot. And the market needs and wants the weaker, lower rates. And I think that's a path that would give other central banks a bit of breathing space. In the scenario where inflation in the US and the US can't cut or won't hike or cut or, is forced to keep rates higher. And eventually, I think this could be a very negative spiral for Asia and Europe on the currency side. And we saw the dynamic of dollar yen, over the last couple of years. And these short-term dynamics, which have been triggered with the unwind of some of these carry trades and the vol pickup, show you some of these imbalances in the system. But I think the big question you're asking, is the dollar in some ways going to remain also, a good defender, a good strong guy to rely on, or not? I think the dollar will continue to show that strong bid, particularly during crisis. But let's not fool ourselves. The US dollar is as guilty as everybody else on the monetary abuse. It's just, has more room and is in better health to do that. I think places like Japan or China are very, very, very limited in their ability to respond. And therefore, I think all the fiat currencies are in trouble. The dollar is in, slightly better shape. If they faced the problem and decided to, dilute their way out they could. And that, perceived dollar weakness or other currency strength is just in the context of what's happening in the currencies. But things like gold or real assets are, I'm not going to say one way, but they are in the long term, because ultimately everyone's playing the same game. And that's, again, going back to why inflation is structural. So the dollar has a really, really big say in what happens, but it's not fully in control. And there are things where the dollar is not in control.
Finally, then, asset allocation in light of everything we discussed so far. What do you think should be the appropriate strategy?
Look, I think, my second book, The Anti-Bubbles, I presented this concept of the anti-bubble, whereby, we're looking at assets that are kind of mirror images of bubbles. We're talking about assets that are artificially cheap, that they give you a hedge. Think about the relationship between S&P and VIX, right? And equity and volatility. And this dynamic, bubble anti-bubble, where artificially low volatility contributes to artificially high equity valuations and vice versa. Artificially high volatility can contribute to artificially low equity valuations through complacency and panic. These are cycles that, there's no good guy and bad guy in this movie. Sometimes equities are cheap, sometimes they're expensive, sometimes volatility is cheap, sometimes it's expensive. The beauty is that they to do it at exactly the opposite time. So in my opinion, I always use the analogy that portfolios and asset allocation is like building a sports team. I'm Spanish, so I use soccer or football, right? But we could use any team. And I think you need strikers, you need attackers, you need assets like equities or credit that will effectively make money in terms of capital gains and income through the benign conditions. But you also need defenders and goalkeepers. And I think in that sense, conventional defenders such as fixed income, which builds the entire thesis of the 60-40 balance portfolio, their ability, their reliability, reactivity, and convexity has been put into question. There are a number of scenarios which we define as the cold drawdown risk, which is the scenarios where fixed income goes down, bonds go down, and equities go down, that effectively show you that your team is really imbalanced. You didn't really have those defenders. So I think the role of anti-bubbles and tail risk and volatility and other sort of protection is critical. And when you build a portfolio, in my opinion, there's no crystal ball. We don't know what's going to happen. I think you need to have, based on your objectives, you need strikers, you need fielders, you need defenders, and you need those goalkeepers. And I think together they will play and result and create much better results in the long term than portfolios that are effectively ignoring the downside risk, that don't have any protection. And in some cases, they fall into the risk of false diversification, which means a very simple idea. You're confusing a portfolio with many things with a diversified portfolio. A portfolio with, not to make wood of a fallen tree, but a portfolio of 20 cryptocurrencies is not necessarily diversified, okay? Because in the time of a crisis, every single one of them might fall at the same time. And it's, at the end of the day, portfolio construction is really about correlation. It's about how you behave. And that behavior is not so much about how you behave on average, but how you behave on stress. And that stress and those conditions, like we saw this week, that's when you see who's really a defender, who's really an attacker, who's really a goalkeeper. And the beauty is building teams that embrace this volatility and take advantage of this bubble anti-bubble dynamics. And that's, in a way, what we do as the goalkeeper of the team. We run mandates that try to effectively deliver reliable reactive convexity, and we do that on a standalone basis as well as combined with long equities. So I think portfolio construction has to be a team effort.
Right. Can you give us one example of an anti-bubble asset?
Sure. So volatility is one example.
Okay.
So you're thinking about.
I see.
The key thing about bubbles and anti-bubbles is, I like to borrow George Soros' definition of a bubble. He talks about bubbles as assets that are artificially expensive based on a belief that happens to be false, what he calls a misconception. So from Soros' perspective, bubbles are artificial setup. It's a matter of time. It's a matter of when, not if, that valuation will implode. What I did, I put my engineering hat, I generalized the framework and said, okay, misconceptions can distort reality, but not only through artificially high valuations, you could also have artificially low valuations, right? So in some ways, what I would tell you is, tell me the misconception, and I'll tell you the bubble and then the anti-bubble, right? And the thing is that when that misconceptions materializes, you get that move happening. So a world of complacency, a world of leverage, a world of artificial, whether it's excessive optimism on growth or, many other ways can actually unwind. So I think one of the easiest way to understand, again, bubble, anti-bubble relationships is the S&P and the VIX and how they move in this reflexive relationship when they feed on each other. I mean, you could have scenarios where volatility increases because equities collapse, and there are times when equities collapse because volatility spikes. I think that hidden leverage that happens through artificially low volatility that accumulates into all sorts of carry trades and short vol and short VIX and carry and stuff, I think it accumulates, and when these things have to unwind and volatility explodes higher, it naturally brings equities lower. So it's a very reflexive relationship that feeds on each other.
Thank you very much, Diego. Where can we learn more from you and study your work?
Well, you can reach out through Twitter or X rather, and LinkedIn. We run a number of strategies. We run monthly newsletters and client calls. So I'm very happy for people to reach out through those channels, Parrilla Diego, RRL, or in Twitter or LinkedIn. And happy to share and compare views with the smart people out there and curious minds that want to continue to learn as we do.
Okay. Thank you very much, Diego. I appreciate it.
My pleasure, David. Thank you so much for having me.
Thank you for watching. Don't forget to like and subscribe.